Guys, before I start digging into specific names that you cover, first, I want to get your thoughts on valuations and just the big runs we've seen in the tech names you cover overall, especially given the fact that mega cap tech has really led the rally off of those March lows. So, Laura, just to start with you, looking at your coverage universe, what do you think of valuations here? What do you think of the moves we've seen? How much farther can your stocks that you look at run?
Right. So I think COVID is actually really good for these mass aggregators because it puts so many small businesses out of business, either because they don't have revenue and they can't sustain losses, or they don't have the balance sheet to survive. So there'll be a lot of very good deals to buy some of those great technologies to be absorbed by these larger companies. And these larger companies have no risk of financial distress, so they are a safe place for investors to hide.
Brent, I'll put the same question to you.
Yeah, for software and internet, software multiples have gone up 20% since COVID hit. No one saw that coming, but I think the recurring revenue that Microsoft, Adobe offer are pretty incredible. So no one wants to leave software right now. For internet, we think there's more room for multiples to go higher. Facebook, we still think, can trade higher. Amazon trade higher. The multiples aren't as outrageous as they are in software. So I think the next leg of software has to come from fundamental improvement, not multiple. And for internet, we think there's a combination that both fundamentals and multiples can go higher and drive these stocks higher. So we're slightly more excited about some of the valuations on the internet side right now.
But Brent, how strong a stomach do you need as an investor to get in here with stocks where they are? I mean, they could go in any direction for quite a period of time, it seems, given, I guess, the positivity that the market seems to be pricing in.
Yeah, I mean, we've had a good move, John. It's a good question. I would just say that this is a permanent shift. We're going to be in distributed architectures now, and this gives power to the software and internet industry. If you listen to Shantanu Narayan last night on Adobe, he had mentioned that this is permanent. This is not a short-term flash in the pan, and this really changes how companies have to invest. It changes the way how we consume content as we're living at home. And so I do think that that there is a more permanent tailwind that's baked in. And I do think right now the questions we have with PMs are, do they want to own airlines, or do they want to own these tech names that have better visibility? Yeah, the multiples are higher, but their business models. And this, by the way, these multiples have continued to climb. And so if you were concerned about valuation in software, you've missed 50 to 80% stock moves. You've completely just been off on the sideline. And that, I don't think, has been the right call. So we're cognizant of multiples, but we would also highlight, Splunk and Workday went to 25 times revenue 6 years ago, and the market caps have doubled, even when they went to 25 times rev. So important fundamentals are the most important thing to keep focused on.
Yeah,
and
I mean, you make a key point there, and certainly,
I would focus on the consumer. I think the more important point is consumers. The consumers have shifted towards technology during COVID, and the FANGs are all consumer-facing businesses. So as consumers change their engagement profiles and spend more time with these consumer-driven businesses online, with pivot to grocery shopping online and purchasing everything online, will never change now. And the key beneficiaries of that are Facebook, Google, Apple, Amazon, and Netflix.
Yeah. Speaking of Netflix, Laura, I mean, this is a name we've been talking to you about for, I guess it's years now. You have an underweight on that particular stock. I mean, certainly we've talked about the risk or rise of competition. We've gotten a lot of those other competitors that have launched their products are out in the marketplace right now. You sticking with that underweight rating, or are your viewpoints on Netflix changing a little bit here?
Yep, nope. We have an underperform on Netflix. Obviously, been wrong during COVID, but it's our point of view that no unbundled service could compete against Apple Plus, Amazon Prime, Disney Plus, which are all bundled services that they can bundle their streaming services to drive other profit centers in their empires. And we don't think Netflix can survive that, especially since it's going to lose another $3 billion in cash flow this year. So it's adding debt at the speed of light to its balance sheet.